is a writer and broadcaster, as I told you. She plugs back learnings the ground to work with regulators and policymakers to make markets safe for ordinary investors. She's the founder of Dhan Chakra Financial Education and the author of Let's Talk Money. She has worked in India's top media, including the Indian Express, Economic Times, and Business Today, and ran TV series around personal finance advice on NDTV, Z, and Bloomberg India. She is member of SEBI's Mutual Fund Advisory Committee. We welcome you once again, ma'am, and request Dr. Gurcharan Tanjil to kindly begin the session.
Thank you. You just heard Mr. Sinha talking about maturing of financial markets, capital markets. And there have been a lot of fears that everybody kind of goes through what happens to me if I become a participant in that as an investor. You resist getting into it because of several reasons. One, possibly a fear. Second, possibly less knowledge about it. Third, possibly without having to have financial education or literacy. So this is something which is what Ms. Halan is trying to correct. So her book, which is Let's Talk Money, we called it Let's Talk Financial Inclusion. Because it is not only about money. The title says very clearly that you have worked hard for it, now let it work hard for you. So how do we make that happen? So at the bottom, we have two objectives. One is poverty eradication. Second is enabling economic activity. Both have a cost. If we are looking at a long-term objective of having to have a financially included country, I think at the household level, thanks to Jan Dhan Yojana, we are already a financially included country at the household level. The credit outreach gap, as per our own study, has dramatically reduced. And many states have gone many notches ahead, registering improvement and growth. Yet, many areas which remain unanswered and untouched. While on the one side we say that there is urban and then there is rural. So urban you can take care of by a different yardstick, and the rural you have to take care of by a different yardstick. There was a financial literacy program which was meant, or financial awareness and investor protection program run by the stock exchanges or the banks. Everybody was an equal participant in that. That has kind of slowed down. There has been a kind of a clamp down, which is, I would say, indirect clamp down on the investor awareness programs, thanks to the regulator there. And the banks themselves have kind of withdrawn from that space for financial literacy and financial awareness. You have been working in this field for a very long time. So what has been your experience? You have tried to capture a few experiences in your book, but otherwise the experience which is gathered from the field, how have you seen that this has been the case, and how should this be corrected?
You are very right. First of all, I am really honored to be here. Thank you for listening to me. So like my work is really on getting people onboarded into financial stability. So it's not really about getting people into investing in risk-based products like mutual funds or even stocks, but really on building financial stability. So what you've asked me is that how have I seen it change and what work is happening? There has been a huge amount of change in the awareness of average people towards wanting to be in control of their financial lives. So we have to take it in context. See, till 1991, we were a socialist economy where the government decided everything. There wasn't any private sector participation in insurance, in mutual funds. It was all government owned. In 91, as the private sector was allowed in, the government has transferred the risk to the people. And that messaging has taken a little bit of time to get transmitted, that we are in charge of our own lives. People still say the government should give more interest. But it's not the government's job to give high interest. Interest rates are linked to inflation. So that transferring of responsibility has happened to middle class India. And what Jan Dhan has done is that it has included millions and millions of people who were out of the financial sector. Now that the pipeline is built into the homes of people whose first interaction with formal finance is happening through a bank, I think the space of financial education and literacy becomes even more important, because through that pipeline they will get products like mutual funds, like insurance, like cryptocurrencies which come in. So therefore the effort to actually build financial education as part of school curriculum becomes really important. So there is an outreach that the regulators do, that companies in themselves do. There's a lot of material created for this education. But I think the real game changer will be when we introduce a few chapters of basic financial education. You know, what is income, what is savings, what are some of those concepts like present value, future value, which all of us need to know, which we can then use in our financial lives. So I think the game changer will be inclusion into the school and then the college curriculums.
I understand where you're coming from, but you know, the point remains that when we talk of credit, there has been very little movement towards livelihood-linked credit. Although, you know, NABARD and several other institutions have been putting their might together. And also you talked about inflation. So how do we do inflation-proofing investment for the people, so that, you know, there is a security net, there's a safety net which is built around them? And that remains a big challenge.
So there has been conversations about RBI introducing something called an inflation-indexed bond, but it has not seen the light of day. So unfortunately, that idea that you have to keep your money ahead of inflation and taxes is part of your decisions. And the one asset which can actually give you inflation plus returns is equity, is the stock market. And again, if you read my book, it is about how do you put on seat belts, how do you secure yourself so that you can take the risk of the market. There is a low risk way to get the average return of the market through something called an index fund. You don't have to choose stocks, you don't have to do derivatives, you don't have to do futures and options. You don't even have to pick a mutual fund, active mutual fund, you can just buy the index. And that's one of the lowest cost, steady long-term return ways of keeping your long-term money inflation plus. For people whose first interaction is with the financial sector through a bank deposit, you know, there are products like the Public Provident Fund, which the government runs, which gives you tax-free return. It's a 15-year deposit. Banks don't like to sell it because there's no commission on it. But a 15-year Public Provident Fund is a very powerful tool in the hands of a person who is just financially included. They cannot take the risk of the markets today. So I think the outreach has to also be about the products that the government itself has, like the Sukanya Sunidhi scheme. You know, so the awareness that these are schemes run by the government, these are safe. Once you have secured some money, then you can free up some money to take risk off the stock market through something called an index fund. But that becomes, you know, it comes to a much higher level of education in finance. But I think it's better to secure such people with safe products and then move to the risky assets.
I switch to the other side of the coin, which is the rural part. To share with you our own experience, you know, we've been doing digital and financial literacy for over 15 years now. And in our experience, you know, initially people were very much interested, which still they are. Institutions were very much interested, which they are not today. And then there is a cost to it. So to your mind, you know, what is the cost of financial inclusion at both levels, and who bears that cost?
So financial inclusion is really, so there's financial inclusion and there is financial education. Financial inclusion is up to schemes of the government, like the Jan Dhan, the entire project was to get people financially included. Now it is up to the product manufacturers to make their products relevant and understood by the people who are going to be buying them. So it's up to the companies to take those products to the people. And the role of the financial education is the third part of this triangle, where the communication about what suits you. You don't buy what is being sold, but you buy what is required for you. And here the role of regulators is very important, where they only allow products which have a fair structure. So, for example, a mutual fund structure is very transparent, very fair, but we cannot say the same about insurance products like endowment and money back. Those are opaque structures. So then it becomes a regulatory issue of allowing products which are fair to investors into the market. So that last mile remains a problem. You're absolutely right that you need, so for even education, you need resources to go to market. So there are funds created by different regulators. There is the Investor Protection Fund. Again, I think they also look for credible projects to start funding, and if that funding has dried up, I don't know about that. But we have also seen the rise of financial influencers. Now, some of the advice is contaminated, I agree with that. But you know, some of them are really doing really good work in terms of just improving the awareness of the products out there, the features of the products, and what you should be doing. So it's a very mixed bag out there of what is available. Also, the number of scams has increased, so people need to be even more careful. So my only request is, if you don't understand something, don't invest in it. If the deal seems to be too good to be true, don't invest in it. If you are feeling safe with real estate, gold, fixed deposits, stay with that. There is no need to take risk that you don't understand. From a person who understands stock markets and encourages people to invest, my communication is equally that. If you don't understand, don't invest. If you don't understand mutual funds, don't invest in them. Only after you have understood and you can use them, should you start investing. And that's the messaging which should go down the line as well.
See, the capital markets, as we discussed, they've really matured and become vibrant. They are also safer and secure, more safer and secure in comparison to what probably it was yesterday. And you rightly said that, you know, as far as regulator is concerned, there have been a lot of efforts to make the investor aware of the product, how to go about doing it, investing and making your investment inflation proof. But yeah, I asked you about the cost, and there's a huge cost to it. But when regulator steps into it, the cost is cut. The interest of the investor is curtailed. So have you seen over a period of time the interest of investor diminishing as far as the exposure to the capital markets are concerned?
It's only increasing. Whatever I can understand is that everyone here would have heard of something called a mutual fund. Is there anyone? Yes. And from the last session, I know that a number of you invest in mutual funds. I have been in this space for more than 20 years. And when I would speak to a group like this 20 years ago, very few people had even heard of something called a mutual fund and were absolutely convinced that it was a scam and they would never invest. So the understanding that there are new modern financial products which can be used to both to buy debt products, equity, gold, combinations of that has dramatically improved. I mean, if you just see the data of investors that stock exchanges release, we've seen a huge number of growth in the registered investors with the stock exchanges and in the mutual fund portfolios. So this is really a demand pull, what we are seeing in India. And you know, people like us, the systematic investment plan is 17,500 crore a month. 17,500 crore rupees. Our 2,000, 5,000, 25,000 rupee SIPs is contributing that much. And I want to share one more thing with you. This is Indian retail money. Some of you might remember till a few years back, there used to be headlines in the papers. FIIs exit Indian markets, markets crash. The foreigners have left India and our stock markets have crashed. That is because there was no Indian retail participation of any significance. Our money, our retail money is giving a flow to the market. The money that we are putting in every month has de-linked us from the whims of foreign capital, which is hot money, which comes in and out according to geopolitics, according to their domestic markets, according to the Fed rate. So I think that there has been a huge change in understanding and awareness. And when the product is demand pull, people make the effort to understand the product and then invest. Mistakes will be made. You will learn only through making some mistakes with your products initially. But I think once it settles in that these are long-term products on the equity side, which need to be funded over 10, 15 years for you really to benefit from it, that is the time that you really start to understand the product and go with it. So I think there has been a huge shift, and also the younger generation is very much in tune with taking risk.
The proof of the pudding is there in the hall itself. When you talk about mutual funds, there were larger number of hands which went up in comparison to the equity investment.
And that is a very good sign, because you see, direct equity investing is a very high-risk job. I know some finance. I've written books on finance. My own personal stock market investing is zero. I do not buy and sell shares. I do not trade, because I think that is a job left to professionals. You need to be able to read balance sheets. You need to be able to decode global events and local events for you to buy a single share in a company. The risk is too high. So even a person like me goes through mutual funds, a person who understands finance. So I'm very glad to hear that this audience is doing sensible investing, that you are diversifying your portfolio. So when you buy directly through stocks, how many can you buy? 5 stocks, 10 stocks at most, right? One mutual fund scheme gives you how many stocks all at once? About 35 to 50 stocks. So your risk is, so imagine what is the probability that the 50 stocks in a mutual fund scheme will all go to zero? If a mutual fund has 50 stocks, what is the probability that all of them will go to zero? The probability is zero. It's not possible. What you do when you invest through a mutual fund is you diversify your portfolio. Through one product, you are buying 50 stocks, right? So that's the logic. And that's the sensible way for investors retail investors, people like us, to invest to get the benefit of the stock market. There is a role for speculators, there's a role for traders. It's not for us. We are professionals, we are government employees, we are busy with being a doctor, lawyer, whoever. That job should be left to professionals.
So how much of financial literacy is a self-evident need? And how does one know that there is a knowledge gap on financial literacy and what one needs to do? So how to do that hand-holding?
No,
Is
so
it a self-evident need?
It is, because you see, I'm sure you will all agree that when it comes to making a decision, we freeze because there's so much choice in the market. We don't know who to trust. The body of financial advisors, which, see, it's a regulatory problem. You need the regulators to do a handshake to certify advisors across regulators to help people, average people, build portfolios. So there is an information gap, there is knowledge asymmetry, and I will put it down to the fact that we have a fragmented regulatory landscape. So it becomes a policy question, unfortunately. But again, just to give you simple advice, that the best time for financial education is when you feel the need of a product, when you go to buy a home loan. That's the time to do a lot of research, to talk to 10 people, to understand home loans better. You don't just take the first home loan. You have to understand fixed rate loans, floating rate loans. You have to understand what is a benchmark against which your floating rate. You have to understand things like, is it are they selling a bundled insurance plan with your home loan, or can you buy it separately? The moment of purchase of a product is the best place for financial education. And something that I have been telling governments and regulators is that you have to make the person selling the educator. You have to design incentives so that the person selling does the right thing by us. Us as consumers of financial products, you've got to get the incentive so that a good outcome for me is also a good outcome for the seller, which we don't have in place. But again, because the marketplace is the way it is, the onus is on us to equip ourselves to understand the product that we are buying, and there is enough information on the net, there's enough resources out there. For a person entering into, say, a medical insurance plan or a life insurance plan, there is enough information out there to equip yourselves to take the right decisions.
So you mean to say that when Jan Dhan started, the need was to get people to open their accounts. So that was when the entire focus was on the banking system, reach out to people, do financial literacy programs, awareness, get people into the fold. Similarly, so when, as you said that, the equity exposure has really, really gone up, but still it's not more than 6 to 7%.
That's right.
Very, very minuscule. It was probably, 4% maybe 5 or 6 years ago.
But mutual fund is also equity.
Yeah,
I would count mutual funds as equity.
Part of that.
Yeah.
I'm talking about capital markets.
Yeah.
So there the investor portfolio is different, and opening a bank account, the portfolio is different. So while the regulator feels that there are enough number of people who have been onboarded on the
no, I don't think
capital markets,
have not
is
said
that the reason
no.
why the
not for a moment am I
government
saying,
has withdrawn or the regulator has
no,
withdrawn from investor
not for a
education?
moment am I saying that enough people have been onboarded. All that I'm saying is that even if the pace of onboarding in risk-bearing products is slow, maybe it is a good thing. We don't want to rush to risk products without enough education on the ground. So I would prefer that the transition to a risk product like equity, like a mutual fund, is slower than an onboarding onto a bank and purchase of government-induced schemes like Public Provident Fund, National Savings Certificate. You have a list of 10, 15 products which are guaranteed by the government on small savings. I think it's a good idea that we push that more than onboarding on the stock market. Stock market demand is coming on its own. It's important that especially middle-class Indians make the transition. I would hesitate to introduce a risk product to a person who has just been financially included.
You've been working in the area of financial inclusion and literacy for a very long time. And finally, you've written this book. What really inspired you to be following this as your passion, or is there a business model to it? Or
No. So I've been a journalist all my life. Till about 3 years ago, I've been a business journalist. I started doing pure business journalism. Somewhere along the line, I shifted to personal finance, which is a subset of business journalism. This is the time that India's first personal finance magazine was being launched. It was called Intelligent Investor that time. Now it's called Outlook Money. So when I made the transition, this is 1997, remember that 91, we opened up the economy. By 97, the modern financial products were just beginning to come. So with the opening of the markets, I started to understand the need for this kind of education and outreach. And so what I actually did is I studied, I became a certified financial planner, I've passed some exams. I don't practice commercially. I keep my work to education, but I have got myself certified. I am a certified financial planner. So that has been the journey. I got deeper and deeper into it. And then finally, I'll tell you what motivated me to keep staying in this space is that the kind of feedback I have got from my readers, my viewers. So I wrote Let's Talk Money 5 years ago. We've done more than 1 lakh copies now. So that's been a real happy thing for me that so many people have read it and benefited from it. My sense of why I continue, I write so much about money, I talk about money, but this is more than money for me. Because every day, for 5 years, I have got messages from readers telling me how that book has changed their life, how much they have benefited, how many mistakes have been prevented, how they've been able to send the children for higher studies, how they've been able to plan for their retirement. Those messages is what keeps me going. The fact that the work that I do is meaningful, it has an impact, a positive impact. And all the people here will resonate with it because you're all, impact creators, change makers in your own spaces. So I think you can understand what I'm saying, that it is really beyond anything to do with the business model. I do so much of free work. If I do corporate workshops, I get them to pay. But but for students, for women's groups and all, it's all pro bono. And you don't get rich writing books. You would know that. You really have to sell in millions to be, super rich by selling books. So it's really a passion to spread this knowledge. And also I realized something, is that, finance is not that difficult. The financial sector makes it so. And when I explain things simply and people understand and are able to take decisions, I think that becomes a real moment of, finally it's about meaning in our lives, no? We do what we do, we get meaning out of getting up every day. That's the meaning for me.
Excellent. One last one. In a run-up to India 2047, financial literacy definitely is going to play a big and phenomenal role. So do you think India needs a financial literacy roadmap, which is not just a tick mark item by the regulator?
I don't know. I don't think it's a regulator issue. I think it's a school textbook issue. I really deeply believe that some basic tools must be given to our young to equip them. So look, we all know how hard we all have studied. Our parents told us, study hard, be somebody, do something. We tell our children, do well. What does doing well mean? It means earning money, right? Basically, you don't want your children to be poor. You want them to be rich. Having money is good. But our entire education system doesn't tell us what to do with the first salary when it comes. We are clueless. We don't know what to do with it. So people don't know how much to spend, what are good ratios, how do you start your personal cash flow managements, how do you build an emergency fund. Building blocks are not taught. So my sense is that some work is on at the moment to include a few pages at least of personal finance in the school curriculum. I'm hoping that the colleges also do that. More than any mission, more than spending money, I think if we can just embed it in the school curriculum, that, because you see, children are very interested. This new lot of kids is very interested in money. This will be a class they will run to understand money better, how to get rich. I mean, why can't we have a chapter called How to Get Rich? Why are we shy of being rich? Isn't money good? It's what you do with it which can be bad. But money itself is good, isn't it? How you earn it can be bad. But money itself is a good thing to have.
Of course, it's the most important thing, makes the world go round.
Yes.
So before we close the discussion, is there any question that we can take one or two from the house?
I see options trading. SEBI has data to show that 90% of retail investors lose money in futures and options. It's a highly risky, speculative activity. Most retail investors I discourage from it. Some people feel they're very good at trading and speculation. My suggestion is, out of 100 rupees that you want to invest, keep 5 rupees for speculation. 95 rupees you put safe. Till the time that you understand that you actually are a great option trader and your 5 rupees has become 100. Then you take 50 rupees out of that and put 50 rupees back. So you keep securing yourself to take the risk, the high risk that speculation is. And ideally, try not to take margin calls, too many margin calls.
Hello, my name is Jit Singh. I came from Scotland. My question is, what is your view about the crypto trading in India? Because it is always a blur,
The what?
Cryptocurrency and
Okay,
the trading.
so I am a crypto skeptic, which
Okay.
means that I am old-fashioned to believe that an asset has to have some underlying value. When you have a bond, you have a borrower and a lender, and there's a stream of interest, and there's a bond price change. When there's a stock, there's an underlying business which makes goods and services, it makes profits and losses. A crypto coin is a digital token which is generated out of a program. I have not found an asset underlying. I haven't found an underlying business proposition. There is a price because there's a demand.
But don't you think the baseline technology is blockchain? So every cryptocurrency which you trade, it has a chain, who has sold it, who has
That's
buy
right, but
it.
what is the business there? I haven't understood the business.
it's based upon like, some tangible, you can call it like from gold, for example.
No, so
Because the gold is very
I want to
limited.
stop you right there. Gold has value
Yeah,
for two reasons.
Yep.
One is because people wear it as jewelry. It's a physical thing. Second is that central banks keep it as a reserve. The day that a central bank keeps a Bitcoin as a reserve, I will say that it is an asset. So this is a longer debate. But for me, also for a country which is so risk averse, which invests in gold and real estate and fixed deposits, to make the leap straight to something called cryptocurrency is not advisable. I do not advise it.
Got your
Absolutely
point.
not.
Thank you very much.
You have to move up the risk ladder, and if you want to do cryptocurrency, again, it's like options. You keep 5 rupees out of 100. And then you experiment with it. Don't put all 100 into it. That 100 can go to 0.
All right.
Thank you.
Thank you so much. So you have heard her speak on Let's Talk Money. Now go and read it.
Thank you so much. Thank you.
Ladies and gentlemen, Ms. Monica Halan, renowned writer broadcaster, was in dialogue with Dr. Gursharan Dhanjal, Vice Chairman SKOCH.